minus 1,153.18. Wow. Just let that number sink in for a second. If you were watching the tickers overnight, you already know exactly what this means. It's the sheer, brutal magnitude of the Dow Jones drop. It's a stark visual of the absolute chaos that just went down during what everyone is already calling Furious Wednesday. We literally saw extreme volatility, totally shattered expectations, and a massive repricing of risk across the entire board. So let's dive right into this. Welcome to today's Explainer, where our mission is to basically decode all these overnight macro shocks. We're going to look right past the panic, dissect the raw data, and build an actionable battle plan so you can navigate this fallout. If you've been feeling the whiplash from the markets over the last 24 hours, trust me, you are in exactly the right place. To get us through this efficiently, here's our roadmap. We'll start with last night's focus, then unpack the Fed's decision. From there, we're going to explore the AI bubble fears, analyze the market reaction, and finally, map out the upcoming hotspots you absolutely need to watch. Section 1, last night's focus, macro versus micro. To really make sense of this carnage, we have to look at the two opposing forces that essentially collided overnight. Section 2, the Fed's decision, the hawkish hold. Let's start with the macro shock, arguably the heavy hitter of the night. So the big news? Chairman Kevin Warsh officially announced the Fed is holding interest rates steady right at that 3.50 to 3.75% range. But listen, this was not a relaxing pause. Not at all. Warsh explicitly refused to offer any comforting forward guidance to the markets. Instead, he hammered home that inflation is remaining stubbornly high, and he specifically pointed the finger at supply chain shocks coming out of the Middle East. He made it crystal clear. The Fed is standing by, fully loaded and ready to intervene if they need to. This is absolutely crucial to understand. This wasn't just a simple pause, it was the very definition of a hawkish hold. Sure, the headline rate didn't budge, but underneath the surface, the aggressive undertone was totally palpable. Up to 3 committee members actually voted to increase rates by another 25 basis points right then and there. The bond market instantly sniffed out this threat. It means the risk of a surprise rate hike down the line is still very much alive and kicking. Okay, Section 3, AI bubble fears, big tech earnings. Let's pivot sharply from the macro interest rate stuff over to the micro environment. While the Fed was shaking up the bond markets, big tech was busy delivering its own shockwaves in the equities market. It brilliantly illustrates the massive divide we're seeing in earnings right now. Just look at this stark contrast. On one hand, you have Microsoft absolutely crushing it. Their cloud revenue skyrocketed by 32%, driving an EPS of $4.81, and their stock grabbed a healthy 2.5% bump after hours. But then, there's Meta. Despite revenue growth, their costs, driven heavily by massive AI investments and legal fees, literally exploded by 55%. Their EPS came in at $6.18, completely missing the expected $7.19. And the result? Meta's stock suffered a brutal 9% crash. What we're seeing here is a massive psychological shift, guys. The market is moving away from that blind AI FOMO and is now aggressively demanding actual tangible ROI. Moving to Section 4, market reaction, predictable carnage. When you combine a hawkish Fed threatening tighter liquidity with huge AI investments failing to pay off instantly for Meta, well, the reaction is pretty predictable. Bringing it back to that opening number, the Dow Jones Industrial Average suffered a violent 1,153-point drop, down 2.19%. Meta's penalty for burning all that cash on AI completely overshadowed Microsoft's cloud success. The broader market effectively lost its patience. Because, heaven forbid an artificial intelligence revolution takes a little longer than a single fiscal quarter to instantly print money. This deep red drop perfectly captures the intense risk aversion and the immense pressure from both those elevated bond yields and the rapidly shifting sentiment. And it wasn't just the Dow. The S&P 500 dropped 1.51%, and the tech-heavy NASDAQ followed right along with it. Like we talked about before this event, the indices weakened and are now retreating all the way down to touch their structural support zones. Now, we might see some minor bounces in the coming sessions, but the data is telling us loud and clear, this is not yet a safe buying opportunity. Don't try to catch a falling knife here. Over in the currency markets, the reaction was a violent tug-of-war. Right after the Fed's announcement, bond yields initially spiked since an immediate rate hike was off the table, but then they just stayed stubbornly high. The US dollar index, the DXY, mirrored this really erratic behavior. It was hovering around that 101.45 mark before suddenly sliding 0.7%. This unexpected little dip in the dollar actually gave the euro room for a brief 0.8% bounce, pushing it up to the 1.1450 zone. Let's check out commodities and see how this all played out. Gold? Man, gold had a truly chaotic journey. Right before the Fed spoke, gold faced heavy selling pressure, dipping super close to $4,000 an ounce. But the second the Fed confirmed they weren't hiking rates today, classic buy the rumor, sell the news action, the bottom fishers swarmed in. Gold shot up nearly 3%, hitting 4,116. But it just couldn't hold it. It evaporated 1.6% of those gains almost immediately, settling back down near the 4,050 mark. It is a wildly volatile environment for precious metals right now. Finally, Section 5, upcoming hotspots, the battle plan. So we've surveyed the overnight damage. The big question now is, what's the immediate battle plan? We have to look ahead, and you really need to brace for a gauntlet of incoming data over the next 24 hours. This evening, we've got the Bank of England's rate decision, which promises extreme volatility for the British pound if the voting is split. Later tonight, the US releases its PCE inflation data, which is the Fed's absolute favorite inflation gauge. This is going to be the final verdict for gold and the dollar this week. And then tomorrow morning, the Bank of Japan drops its interest rate decision, which brings us to a very, very critical warning. You need to pay close attention to this. The USD/JPY currency pair is trading right around 163.50. The Japanese yen has been stuck at multi-decade lows, and if you're a buyer of this pair, you need to be extremely vigilant. We are in a state of maximum danger here. Any hawkish move or even a direct currency intervention from the Bank of Japan tomorrow morning has the potential to wipe out 300 to 500 pips in a matter of minutes. The data is practically screaming at us to consider closing out long positions on the USD/JPY before tomorrow morning to protect your capital. Distilling everything we've looked at today across central bank policies and tech earnings, here is your ultimate actionable takeaway. The hawkishness from the Fed clearly tells us that the current macro environment strongly favors holding cash and maintaining a strict defensive posture. With the market demanding real ROI and harshly punishing overspending, you absolutely must limit the temptation to bottom fish in tech stocks right now. Risk management has got to be incredibly tight ahead of these upcoming central bank events. So, we've seen the numbers, we've tracked the volatility, and we know exactly what catalysts are looming on the horizon. The market is aggressively shifting from unchecked optimism to strict accountability. So, I'll leave you to reflect on this. With an environment that is clearly favoring cash and actively punishing risk, are you ready to play defense today, or are you about to get caught on the wrong side of the next macro shock? Thanks for joining me on this explainer, and definitely stay sharp out there in the markets.